Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome everyone to the first ever Old Capital Real Estate Investing Podcast. I am Michael Becker and I'm here with Paul Peebles.
Hello.
We are with Old Capital, a Texas-based commercial real estate debt and equity firm that specializes in the multifamily space. The purpose of this podcast really is to bring you interviews with real-life people who are out there making it happen. We'll have interviews with owners, brokers, management companies, and other people in the industry. We really truly hope that we can add some valuable insight to everybody on what it's really like to identify properties, raise equity, secure debt, and operate an apartment complex of people who are really actually out there actively doing it. Let me start off by giving you guys just a brief introduction on Paul and myself. Paul's a national underwriter at Old Capital. He has over 28 years of real estate lending experience, having closed over 4,000 loans in his career. Paul really brings a deep knowledge of the capital markets and has numerous long-term relationships with the decision makers at the various capital sources. I certainly categorize him as a deal maker. You'd be hard to find someone else who's more connected and knowledgeable in the multifamily space than Paul. I, Michael Becker, am the Senior Director at Old Capital. I'm a 15-year veteran in the banking industry, having closed in excess of $500 million in real estate transactions. On top of that, I'm the lead principal in over 1,000 apartment units here in the DFW area, so the perspective of both borrowing money and lending money, as well as what it's like to operate an actual apartment complex. To find out more on Old Capital, please go to oldcapitallending.com. There you can see more information on what we do and sign up to get on our weekly email list showing the deals that we have recently closed and updates on topics that affect the industry. Let me send it over to Paul to give you a brief summary on what you can expect in today's interview.
Thanks, Mike. In today's interview, I had the pleasure to visit with Mac Lawson, a client of Old Capital who has a great story. He started as a professional in the financial services industry as a bond trader and then realized that he wanted to take control over his own destiny, and he's certainly done that. He currently owns a 176-unit apartment complex and over 50 homes in Dallas. Mac has overcome numerous challenges along the way and was gracious enough to share his story with all of us.
Without further delay, let's throw it over to today's interview.
Hey, thanks, Mike. We appreciate the time. So Mac has joined us on the Old Capital podcast today, and everyone meet Mac. Mac, meet everyone.
Hello, everyone. My name is Mac Lawson.
Mac, thanks for the time today. I appreciate it. Really, probably the best thing we could do is kind of work backwards. And first of all, let's start at the end. Mac owns, 176 units here in Dallas, an apartment building. And Mac, what else do you own?
I've got a portfolio of seller-financed houses as well as rental houses.
And how many are there? Just give me a kind of a ballpark.
We've got 53 rent houses and probably a portfolio of 27 notes.
Wow. So you got a lot of things, a lot of moving parts going on in Mac Lawson's life. But I think what people are looking for is just a little bit of advice, how you got going and how to be successful to get to the level that you're at right now. And Mac, if you can kind of give me a little bit of background on you and tell us a little bit more about your real estate experience.
Well, one of the interesting things about this is that this process didn't start all that long ago. It goes back to about 2011 was my first acquisition. Mm-hmm. And, we've come a long way in, 4 years now? 3 years now?
Sure.
4 years?
Yeah.
So we just really got after it. We saw an opportunity in the market and capitalized upon it.
And what's your background? I know that you're a Texas Longhorn alum. And what did you do when you came out of college?
Thinking that the stocks were the way to go, I went to work for Fidelity Investments and worked on their bond trading desk for 10 straight years. And then ultimately it felt like Groundhog Day there, is that every day just kind of seemed the same, and decided to venture out in the market. And I went to work for a land investment company. We specialized in buying large tracts of land and figuring out where the roads are going to go and where the utilities are going to come from, and annexation into cities.
All right. How long were you there?
I was there for 11 years.
Okay. So that kind of wound down, or did you just see the opportunity in real estate? I mean, how did you make the transition from land sales and big blocks to small little homes in the middle of suburban urban areas?
Well, my story is probably not that different from a lot of other people. I mean, I was in real estate, but I did a very specialized thing in real estate, and I was a high-paid employee is what it was. And ultimately, after about 11 years, I had to decide what I really wanted to do with my life going forward, of owning my own destiny, so to speak, and doing my own thing and being in control of the car that I was riding in. So I decided to start buying these small rental houses, and I bought 1, 2, 3, 4, got up to about 14, and those started taking care of the daily bread, so to speak.
And how did you buy those? Did you just pay cash? Did you loans against those properties? Did you do it with a little community bank? I mean, how did you put that together?
What I did was essentially I had a line of credit. So I went and borrowed against my house, and I would go out and buy 3 or 4 rent houses, and I would run up the balance of the line of credit on my house, and then I would take those to the bank, and then the bank would pay back my line of credit, and I would own the houses with a long-term, well, most of them are 15-year notes, but long-term fixed-rate debt. And I would capture the equity that I had made in the meantime between the time that I had it on my line of credit versus financing it for the long term.
So your first go-around, did you just buy 1, 2, 3, 4, 10, 15? How many properties did you buy at one time, and how did you get your name out there that you were buying properties?
Well, it's kind of an interesting story. I mean, I had friends that would call me and ask me what I was doing, and each day I had Realtor.com just go out and scour the market for houses that were between $50,000 and $75,000. And ultimately, at that time that I was doing that, almost every single one of them that came through was just a screaming bargain, in my opinion, based upon where the market was.
At that time?
At that time. So I had a friend of mine ask me how much time I was actually spending on this. And my explanation to him of what I was doing and how I was doing it was probably more time than I spent on it in the entire week. So I would go online, I would buy a house, I would have my contractor go out there and bid it for me, and the negotiation that I had with my contractor is that when you finish this project, I want to go out there when you start and when you finish. And if you finish and I go out there, if you tell me you're finished and I go out there and there's a Coke can on the floor, I'm not going to bend over and pick up the Coke can. I said the only way that I can do this with a high-paying job at the time was to have nothing to do with it. So I really had to set my business on autopilot to a certain extent.
So you bought a couple homes, and then tell me again, you went from 5, 6. Now you weren't buying stabilized properties; you were buying properties that had, a little bit of deferred maintenance or a lot of bit of deferred maintenance. I mean, give me a little bit more of an example of what your business model is when you buy a single-family home.
That is an interesting thing to look back at. Is that one of the reasons that I am able to do the apartment complexes probably better than most is that the perspective that I got into this business with, one was to have somebody else manage it and have somebody else to do the majority of the work and just to be a supervisor of that work. And the second one was to buy typically the most rundown, beat up house that I could find. So that's where I started, with really buying distressed properties. And the reason I did that was you could buy the property for extra cheap, and a lot of other people didn't want to do that. And I knew that when I finished with that property, when I got through rehabbing that property, everything was new or like new.
Give me an example of what's a typical size of a transaction that you would buy. What was the value of the property? What's the purchase price? And what was your leverage in the deal? How did you structure the deals?
Yes, on those original houses that I started buying, I would generally scout houses between the $50,000 and $75,000 range. I would look for houses that needed about $20,000 worth of work, and that included a new roof, new hot water heater, new floors, everything. And once I was finished, they would appraise for somewhere between $110,000 to $125,000.
So fairly affordable areas that you were buying in, and what were rents typically on something like that?
Rents average probably about $1,000 a month.
And you have a mortgage payment against that?
Yes, ultimately I had a mortgage payment. My mortgage payment ended up being, it's kind of hard to remember now, but $500 maybe all in on the mortgage.
So you're making some positive cash flow. But you knew that, like in the game of Monopoly, you had so many homes that you wanted to eventually trade some of those homes in with some of your experience you had gained into the apartments. And tell me a little bit about when did you make the transition into apartments, how long ago that was, and how did you find your first transaction?
Well, yes, what happened is that ultimately with the houses, there's just you hear other people say it, there's just not enough volume in it, in that I was a high-paid employee and I had to replace a fairly large salary. So the number of houses that I had to do was kind of staggering in order to completely leave the job and have that take care of everything for me. So I started looking at the next level, and the next level was an apartment complex.
And how did you get your apartment complex? How was it presented to you? How did you tell us a little bit more about how far it was from your house? Tell us some of these little intricate things.
Sure. The first apartment complex that I bought was a 62 unit, and it's in East Dallas. And it had been on, I don't know if you're familiar with LoopNet, but it had been on LoopNet for a year, and they had been trying to sell it and just couldn't sell it. And I said I wanted to buy it, and I had about 5 people tell me that was crazy, that I shouldn't do it. But coming with my perspective from those houses is that I always focused on the one that needed a complete rehab, complete makeover, because I could control it. I could determine that everything was fixed, new or like new. And so I bought my first apartment complex from a bank in Florida. This bank in Florida came to own that apartment complex through 3 series of transactions. So one bank got gobbled up by another bank that got gobbled up by another bank that ultimately ended up at this bank in Florida, who hadn't written the loan, didn't know much about the loan, didn't even know where it was, and wanted to get rid of it desperately. They had on-site management that was poor, would be a generous way of describing the on-site management that was there at the time. They were losing money. It was overrun with drug dealers and criminals, essentially. And I saw gold. I saw gold underneath all that.
Well, let's kind of go through the numbers on that one, because I think that's kind of a fascinating deal. So you bought a kind of a heavily distressed asset from a bank that was the asset owner of the property. They probably never put a lot of money into the property. They weren't interested in turning around. They were just kind of glorified babysitters on the property. And so, in this property was how far from your house?
Oh, gosh, it's probably 15 minutes tops.
So not too far.
Not too far.
So you were able to really keep an eye on the property. So when did you buy the property and what did you pay for it?
I bought the property March of 2011.
Okay.
And we had to pay cash for it. So this was a pretty big chunk of cash. We paid $660,000 for 62 units.
And did you do a group purchase, or did you pay for this by yourself? Or
well, this is where I brought my brother into the process. So my brother and I each invested $330,000 into the purchase of this apartment complex.
Okay. So you guys take over the property. The closing went, I would think, probably pretty smoothly since you paid for the property in cash. Did you do an appraisal on the property, or did you just kind of have a great idea that this was the valuation of the property and it was worth what you were paying for it?
Well, it's hard to remember. I think we did do an appraisal, and I think it did appraise for more than we were paying for it, but we didn't have some of those restrictions like other people had because of the way that we bought it.
Tell me a little bit about the first week or month that you guys took over the property from all the hoodlums on site.
People like hearing this story. It's pretty funny, to be honest with you, but we closed on the property on a Thursday and went through our normal due diligence on the property and went through the lease files, and we pulled every Social Security number out of the lease files, and we went to the police station and went through all of the Social Security numbers and fed them to the police, and the police did a warrant background search, not just a credit and rental history background, but an active warrant search. Wow. So the police came up with 9 outstanding current warrants of residents that lived in the property. At the time, there were 48 residents.
So you're not kidding me. There was hoodlums on the property.
It was bad. So we went to the police station. They went through they went through this process. So we bought it on Thursday, and on Saturday night, 8 police cars, 16 policemen blocked the entrance and the exits of the property, and they knew exactly who they were looking for. They were looking for 9 individuals, and they physically took off about 15% of our rent roll left in a police car, handcuffed.
That's pretty wild. One of the stories, I think you'll get a chuckle out of all the stories that Mac can tell, but one of the funniest things was these people used to climb over the fence or go through the bars of the fence because there was a lot of independent pharmaceutical reps on the property that would want to
come and go in the back of the property, essentially. Yeah.
That's it. So tell me a little bit about how you took care of some of these independent pharmaceutical reps.
Well, I take no credit for this because I listen to what other people do, and I just do it myself. And so I don't take any credit for it, but we learned this trick is to use axle grease on the fences. So we bought 50 gallons of axle grease and had our maintenance guys go out there with sponges and gloves and axle grease the whole fence down. And not only does it get on people's clothes if they go back and forth through the fence and keep them from obviously climbing over the fence because it's difficult to grab onto it, but at the same time, it makes the fence look brand new.
That is a deterrent. I love that story. So you brought in the police. You kind of threw out the bad guys. And now, did you reposition the property with a different name that had been the old name was associated with the hoodlums, but you were looking to put a different demographic on the property? Tell me a little bit about how'd you do that and how'd you choose the name and all those good things.
I definitely did market it. It was known as Spring Gardens before I purchased it, and we changed the name to Casa San Luis. There was a little bit of thought in the process of Casa San Luis. Is that we pulled some of the people walking down the street in front of it and at the grocery store and asked them where they were from, and quite a few of them were from San Luis in Mexico.
Oh, okay. I get it.
And so we kind of just targeted that to make it feel like home to the people that were in the neighborhood. And we took occupancy we had 48 residents, and within 1 month, we went from 70% occupancy down to 17% occupancy.
So when you buy a property, your pro forma always says that you're going to go up in your occupancy because that's what your wishes and your plans are. But what you're telling me is that you actually went south and your numbers actually got worse than you were projecting, or you knew that going into it that was going to get even worse?
We absolutely had a plan, and the plan was to get rid of anybody that was going to cause problems and also anybody that had a criminal record. We stopped leasing to people that had criminal records. And, ultimately it took 1 month to get everybody out. And what that allowed us to do also was to go in there during the rehab and not be having to working around residents as much, is that it just wasn't as occupied. So a lot of the units were open and available for rehab, and that was the second part of the project. Was we spent $300,000 on rehab.
So you paid for what, $660?
$660.
Yeah, you put about $300,000 of rehab, so your all-in price was about $960,000. And so, how long did, from the period of time that occupancy was so far down to the period of time that occupancy was so far up that it was starting to look like it was stabilized? How long did it take you to get there? And you didn't do this by yourself. Did you hire a management company that kind of knew the area and knew the demographic?
Absolutely. I did a lot of things. I patterned it a lot after my house, is that I wasn't down there supervising the construction. I actually hired a construction engineer to oversee the rehab of the property. I also hired a management company that owned 440 units less than a quarter of a mile away. And so they had access to 7 maintenance people, 4 leasing, 2 managers on that property. And it was a very, very good economies of scale. They could run my apartment complex with pretty much the spare people from their other apartments. And this is where the pro forma didn't really match what we estimated. I mean, It was an incredible 3 months. So it took us 1 month to get everybody out. It took us 1 month to rehab all the units. And within 1 month later, so 3 months from the time that I purchased it, it was at 95% occupancy.
So 90 days later, was at how much?
90 days later, it was pretty much fully occupied.
Boy, you're a 90-day wonder. Tell us some of the things that you rehabbed. I mean, where did some of the money go The $300,000. What was the things that you made the greatest pop on that deal?
Well, we did just about everything, and one of the things that I did like about this was it had individual ACs and a house type of a roof. It wasn't a flat roof; it was
Just a standard shingle roof.
Yeah, a standard shingle roof. And the reason is that like for individual ACs, you can get almost anybody to work on an individual AC. And so we could get the labor pretty cheap, and we could get people that were familiar with it. We could get enough people on the property quickly that could handle the replacement of all the ACs and also the roof. It was just almost like a standard house roof. Mm-hmm. And so there's 4,000 roofers in Dallas, and any one of them can work on that roof just as well as probably the other ones. So it was very basic as far as the type of rehab. So we got people on it right away.
Wow. All right. So you had the property stabilized 90 days from the period of time that you bought it to the period of time that you sold it. How long was that?
Well, I bought it in March of 2011, and I sold it in November of 2012.
Okay.
So I think it was about 18 months.
18 months.
Something like that.
And what did the person who bought it from you, what did they pay for it?
They bought it from me for $1.5 million.
So let me make sure I have the numbers correctly. You bought it for $660,000. You put rehab about $300,000. So your all-in was about $960,000, and you sold it for about $1.5 million or so. And during that period of time, you were cash flowing probably pretty large or so. What was your cash flow?
For 12 months of that 18 months, we took out about $10,000 a month. So it was cash flowing very well after about 6 months.
Another $120,000 that you got up and above the deal.
So we pulled out $120,000 in cash while we owned it, and then we sold it for $1.5 million, which generated $600,000. Yeah, ultimately ended up being about $620,000 that we made on it.
And why do you think the person who bought it from you, why were they buying it? Were they interested to try to do a value-added property, or they were looking for more of a stabilized?
Well, that's interesting because there are definitely segments of the market. And this was a value play when I bought it. It required a major amount of lifting. And ultimately, our goals were different than other people that buy an apartment complex that's already operating properly and just needs, and it's a financing issue. Our goal was to get it up to 95% and run it at 95% to have it as a stabilized property. It just needs to run in the 90s for about 6 months in order to be a stabilized property.
Okay.
And so that was our main goal. We weren't pushing rents. We weren't charging for parking. We had one unit that was unpermitted, so we just vacated the unit. So there was a unit that was down that could have been brought back up, but it just needed to go through the city process. But our focus was not on incremental change. It was on major change. So we focused on the rehab of it.
So you went from single-family homes. This was your first multifamily property of 60-some doors, and now you're sitting on $600,000 worth of additional equity. What did you do with the money, and where did that go to?
Well, we actually decided we probably could have done a 1031 exchange, which just means that you don't have to pay money on the gain that you've made, but it requires you to fit into some boxes, and I didn't necessarily want to fit into those boxes. I didn't want to go make a bad decision on buying another apartment complex based upon the taxes. And also after a consult with my accountant, the long-term capital gains rate was at 15%. So me and my brother just decided to pay tax on that, on our gains. And we took the gains and we bought 176 units.
So, and where's that property located at, and how far from your other property?
Well, we sold in November of 2012, and we bought in February of 2013. So about 4 or 5 months later, something like that.
And how did you find that deal? Now, because you owned a property in that same submarket, did you have a lot of listing agents wanting you to buy their properties? I mean, how did you find this one?
Well, ultimately, that's what happens is that once you prove you can be successful at doing this, you get approached by a lot of people that are interested in either selling or representing you or something like that. And I had proved that I could buy a distressed property, rehab it, and sell it. And so if you go through that whole process, it lends a little bit more credibility to you. So I did get approached by a lot of different brokers. I ultimately, in the purchase of Casa Bella was 176 units in February of 2013, ultimately went to the listing broker, and ultimately the listing broker got both sides of the commission. So I decided not to take a commission on it, which I probably could have, but it incentivized him to make sure that I was the best possible buyer for this.
So 176 units, property is in East Dallas. You currently own the property still to today. And tell me a little bit about what does that property look like? So in people's eyes, is that pitch roof, flat roof, individually metered, two-pipe chiller? Tell me a little bit about what that looks like.
Well, I broke away from a couple of the basics that I did on the first one, but on the 176 units, it's a flat roof. It's 21 buildings. It's almost 8 acres. It's located on a very busy street. The apartment complex itself, the interiors are very quiet and nice, and it's got some courtyards and things like that are off the street. So,
being on a busy street, does that help market the property better than being on like an interior street?
I think so. The two that I have bought have been on, they get a lot of drive-by traffic, and I personally think the more people that you can get in front of your leasing agents, the better off you're going to be.
So tell me, what did you pay for the property?
I purchased the property for $2.4 million.
Okay, and what's that come out to in terms of a per unit basis?
Well, Spring Gardens, the first apartment complex that I bought, was at about a little bit over $11,000 a door.
Wow.
Yeah, and this one was a little bit under $14 a door, so about $13,750.
What year is this property?
It's a 1976 property.
1976, individually metered, individual HVAC.
Individual HVAC. It's a stucco, which I wasn't super excited about because, when you do something that's stucco, there's just less people that can work on stucco.
It kind of looks like it belongs in Phoenix or Tucson. What do you think? So it kind of stands out a little bit in the regular, hardy board property that you're going to see usually in East Dallas.
Kind of a Spanish architecture. It was already called Casa Bella when I bought it. We considered changing the name, but it didn't have necessarily a terrible reputation. It wasn't as distressed as the first one that I bought. We did not kick everybody out. We kept it pretty well occupied while we were doing our rehab.
So how much did you spend in rehab, and where did those dollars go into?
We spent $1.1 million in rehab of the property. And the major item that was on that was the roof. It's a flat roof, like I said, so the roof was a little bit more expensive than other roofs would have been. But with that, we had to start at the top. So the stucco there's water going down behind the stucco, and the stucco was deteriorating. So we had to start at the top, and we had to fix the roof first, and then fix all the stucco, and then fix all the landings down at the porches and stuff, patios.
Okay. And so you're all in at the deal about $3.5 million. You did a loan on this property, where the first one you paid for in cash, which would probably be kind of difficult to come up with $2.7 million. And so how much money did you actually bring to the table for your portion of the equity?
My brother and I actually took about $900,000 from the sale of Casa San Luis. And $900,000. So we put $100,000 in the bank just as a cushion, and then we put $800,000 towards equity. So my total cost into the project is $3.5 million, of which $2.7 is debt and about $800,000 is equity.
Okay, and so you financed that through Old Capital, and that was done through one of our regional banks. Tell us a little bit about what the terms were that you had on the transaction.
Well, Old Capital really came through on that one. We had to close in a fairly short period of time, had a couple road bumps in the way towards closing. We ended up going through one lender, and then ultimately at the last minute switched to another lender, and Old Capital really walked us through that process. But the loan itself was through a bank, and it's a national bank. I've got a 5% interest rate.
Okay.
And it's a 3-year loan, so it's called a bridge loan. And that encompasses the cost of the rehab plus the cost of the acquisition. And so we had all the money available for the rehab that we were going to do.
Okay, and so that loan came with a series of draws, and so the bank would provide the quarterly or monthly draws to pay for the rehab to the property. So you included not only the acquisition price plus the rehab dollars, and you got, what, 70%, 75% leverage in the deal?
Don't remember off the top of my head, but yeah, something like that. 70, 75.
It was probably about 75%. Did you get some interest only during that period?
I did.
Of time?
So for the first 18 months of the loan, it's an interest-only payment, which is nice.
That's good. Now you own it. You've told us some funny stories about being an apartment owner on the last property, Casa San Luis. What do you think everybody would think would be a chuckle on Casa Bella? What are some of the things that stand out in your mind that people should understand about some of the challenges in apartment ownership?
Well, definitely none of these are cakewalk. There are things that need to get taken care of while you own it. We had a fight in the parking lot that was videotaped, so we had 20 people in our parking lot fighting one night, which was not good. But anyway, we sent out eviction notices to all of them because we saw them on the cameras and we could pick out who they were. And so every one of those people that involved in that fight were sent eviction notices. So you just have to be very, very firm. You can't be scared of losing residents, because I know that if I provide a good, clean, safe place to live, I will get the right type of residents. So I'm never scared of kicking people out. I never keep people there that shouldn't be there. And it really shows among the other tenants and other residents as to who's in charge and creating a nice, safe place to live.
Now, you had a management company manage Casa San Luis. And I think you remember telling me that you had them also try to manage Casa Bella. They had kind of a change in personnel. You said goodbye to that old management company. You picked up another new management company. What did the new management company find that the old management company didn't find?
It's interesting because this business, you hear about the old guys saying, oh, it's all about the people. And it really is about the people. You can have a pretty poor apartment complex in an affordable neighborhood, even in a bad neighborhood that's run properly. And if management is right, then the apartment is successful. And if management is wrong, it doesn't matter where it is. It doesn't matter what type of asset it is. It won't be successful. And so that was a painful thing for me to do, is to replace the management. But I did that in December of 2012, said goodbye to my old management, went out and interviewed about 4 or 5 different managers.
December 2012 or 2014?
I'm sorry, 2013, yeah.
Okay.
December of 2013.
Okay. So just about 10 months or 9 months after you bought it, you replaced the old management company with the new management company. And what did you find?
I just found, a world of difference. Like I said, it's all about the people. And all of a sudden, collections went up. All of a sudden, drama went down. Financial reporting was on track. You've got to find the right people to do the job for you. And just like on Spring Gardens, the rehab was managed by a construction engineer. I paid a construction engineer to oversee my rehab because I don't know that much about stucco. I don't know that much about flat roofs. I don't know very much about ACs, except that they cost a lot. And, I had a professional engineer in place of myself managing that for me. And it's the same way with the property management. I have a professional property management that is very good at what they do and take great care of the asset. And another part of this also was just, I like the Michael Gerber book, The E-Myth. You want to work on your business and not in your business. I didn't want to be down there collecting rents, and I didn't want to be down there scolding the maintenance guy and deciding whether he was going to stay or go. And so I outsourced all of that. And in my opinion, if a deal cannot support that type of management, then it's not worth doing.
So tell me a little bit about where we're at today. Where's occupancy? Where's profitability? I mean, give me some hard numbers. What was your NOI when you bought it, and where is it today?
Well, NOI when I bought it was at about $70,000 a month. The gross revenues were about $70,000 a month. And my expenses were probably about $74,000 a month. So, it ran that way for almost 10 months while I was under construction and while I had the previous management on it. And now, today, I think collections this month are going to be 103 this month, and our expenses are 58.
So you did it the right way. So you brought up income, you brought down expenses. The new management company kept a real close eye on water because that was one of the things that landlord paid. New management company kept an eye on electricity costs in the common areas, and so now you're instead of losing $4,000 or $10,000 a month, you're making a good pretty penny. So what's kind of the future for you in Casabella? What's your next move?
Yeah, let's put this in perspective. So I was losing $4,000 a month last year on it, which was expected. I mean, it was part of our pro forma on this one was to not have it cash flow from the very beginning and to do the rehabs and then raise rents and fill it up. But we went from $4,000 a month loss to $42,000 a month positive.
Wow.
So what that did to values was just astounding. So I'm all in it for about 3.5, and I'm going with Old Capital to refinance this. They've looked at the deal. They've looked at the profit and loss for the past since December. And the valuations based upon other apartments in the area puts it at about $5.3 million.
So you bought it at 2.4. You put 1.1 into it. You're all in for 3.5, but we're thinking that the property's now, because with the increased NOI and that cap rate, our valuation's about 5.3.
5.3 million.
And so you're thinking about right now of paying off the regional bank debt and putting some Fannie Mae 30-year amortized 10-year term, a rate under 4.5%. And what's probably the biggest difference? Is it the difference going from a recourse loan to a non-recourse loan? Is that one of the things?
Well, everything I've done to date has been recourse. And so for me, it's kind of a new world that I'm entering into of having non-recourse. I look at it as if I owe money, then I'm responsible for paying back that money no matter what. Mm-hmm. And so for me, recourse or non-recourse isn't as important as it is for some people, especially guys that have limited partnerships and things like that. But all that being said, I really had to go through and make a decision about whether I wanted to sell this or whether I wanted to refinance it. And the conclusion that I came to that it was better to refinance this than to sell it.
Because it's going to give you a monthly cash flow. You could make the argument selling into the strength of the market right now in the apartment side, but then you have to go out and find another apartment to replace that property. But if you're looking for a non-recourse, getting a monthly paycheck, so to speak, on your cash flow, that's a pretty compelling argument to make. It's not the right thing for everybody, but in this case, based on discussions with Mac, he thought it was a prudent thing to do, and we agree with him.
Well, let's walk through those numbers a little bit more. That's an important distinction that people who are doing this need to kind of think through the positives and the negatives associated with why you would do one way or the other. And here are the numbers. The current value at $5.3 million. The new debt, so Fannie Mae will lend 75% of that.
Because it's a cash out.
Because it's a cash out, right?
And how much cash out are you taking?
Well, the new loan would replace the old loan. So the old loan was at $2.7 million. The new loan would be $3,960,000, somewhere around there.
Okay.
$3,960,000. That would leave about $1,320,000 in cash coming out of the project.
So $1.3 million coming out in cash.
And I've got a safety account of $100,000, and I have $800,000 in equity inside, that was put into the project from the beginning. And so, out of $1.32 million, we're looking at a profit cash out of $520,000 plus our original equity back.
Wow.
And not only that, here's the big kicker. Mm-hmm. So on a go forward basis, if our gross revenues on a monthly basis are $100,000, and we can maintain the $58,000 a month in expenses, that brings us $42,000 a month in excess cash. And that cash needs to go down to pay, needs to pay debt and things like that. So, but that $42,000 a month is after expenses, after all the expenses associated with the property. So, making an assumption of $25,000 a month. I haven't really done the calculations, so that might be a little bit high or low. But 42 minus 25 is somewhere around $17,000 a month.
So $17,000 a month, and you've gotten your equity back, and you're sitting on another $500,000+ in cash to go out and buy something else. Well, Mac, I can't thank you enough. Boy, you've spent a lot of time with us, a lot of time with our group over at Old Capital Podcast, and I really appreciate it. And that we look forward to seeing what you're buying next time, and hopefully we can visit with you sometime in the next year or so and see what you did with all that cash out.
Well, if you ever need anything, I'm always available. So
all right,
happy to help.
Thanks, Mac. We appreciate your time.
Paul, I thought that was a great interview. Mac's really out there making it happen. He has seemingly mastered the art of taking on some really difficult properties, while leveraging the efforts of his real estate team members to do most of the heavy lifting along the way. He's really a good example of the powerful potential positive effects of real estate if done correctly. He's on the way to creating great legacy for generations to come for his family, all while being a super nice guy. Again, if you guys want to find out more information on Old Capital, please go to oldcapitallending.com and sign up to get on our weekly email list showing the deals that we have recently closed and updates on topics that affect the industry. To contact Paula or I, please go to our team under the Our Profile section of our website, and there you can find all our contact information. If you like what you hear, please subscribe to the podcast on iTunes and give us a 5-star rating. It really does help us move up the iTunes rankings and get our podcast exposed to more and more people. Thanks for taking time to listen, and please join us next week when we have another great interview.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.